Okay, let's dive into this explainer. Today we're unpacking a massive, kind of hidden shift that's happening right now in the financial world. Now, you've probably heard your entire life that the S&P 500 is the ultimate, safest passive investment out there, right? The logic is always set it, forget it, let the 500 biggest American companies do the heavy lifting, and just watch your wealth grow. But if we look at the recent data, there is a giant risk forming right under our noses, and it is being driven entirely by this absolute frenzy around artificial intelligence.
40 cents. Believe it or not, for every single dollar you passively invest into the S&P 500 right now, 40 cents of it is going to just 10 companies. That's it. We're talking about the heavy hitters here: NVIDIA, Microsoft, Apple, Amazon, Meta. Lately, these 10 giants make up a staggering 40% of the entire index. And honestly, it gets crazier, because NVIDIA alone is snatching up about 7 to 8 cents of every dollar you put in. So why is the market suddenly so top-heavy? Well, it's because these specific companies are all aggressively borrowing and spending astronomical amounts of money on AI.
$2 trillion. Let that massive figure just sink in for a second. For these huge tech and AI companies to actually justify their current sky-high market valuations, they would need to generate around $2 trillion in future revenue. To put that into perspective for you, that is more money than NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta made combined in 2024. They are essentially placing a massive debt-fueled bet that AI is the definitive future of everything. And it creates this wild, dangerous feedback loop, you know? Bigger companies attract more passive investment, which artificially pumps their stock prices even higher, which then gives them an even bigger share of the S&P 500.
So, how in the world do we navigate this incredibly concentrated market without getting burned? We absolutely need a new blueprint. In today's explainer, we're going to follow these 5 clear steps. First, we'll break down the index fund dilemma. Second, going global over America. Third, we'll decode the 4 zones of AI. Fourth, navigating the new gold rush. And finally, number 5, understanding exactly why cash is king. Okay, starting off with part 1, the index fund dilemma, looking specifically at equal weight versus market cap weight.
Now, you might naturally be thinking, hey, if the S&P 500 is way too top-heavy with these AI companies, why not just spread our money equally across all 500 companies instead? And actually, that's exactly what an equal-weighted index fund does. On paper, sounds like the perfect fix. Instead of 40% locked up at the very top, every single company gets an equal slice of the pie, sitting at around 2%. But, and this is a big but, equal weighting creates a massive mathematical headache called negative momentum. See, to keep every company perfectly balanced at that 2% mark, the fund is constantly forced to sell its winners, like say a Tesla during a huge bull run, and use that cash to buy the losers. You are literally being punished for a stock's success just to keep the scales even. Plus, all that constant buying and selling racks up high trading fees, which eat straight into your long-term gains. Contrast that with a traditional market cap weighted fund, which just naturally lets the winners run and keeps your costs super low. It's a really tough dilemma for the passive investor.
So, if just tweaking the US index fund isn't the magic bullet, what is? Which brings us to part 2, going global over America, and this fascinating concept of the layered cake of markets. To really grasp this shift, try thinking of the total global stock market like a massive layered cake. The cake itself, representing total global trade, it doesn't really change, but the thickness of the individual layers, which represent different countries, shifts wildly over time. And this brilliantly illustrates why betting everything solely on America is actually a huge historical risk. Look back at the year 1900. The UK was the undisputed global superpower, making up a whopping 24% of the global stock market. Investing heavily anywhere else back then would have seemed totally crazy. But history shifts, right? Fast forward to the late 1980s and early 90s, and suddenly Japan was the future. They were dominating cars, dominating electronics, while the US economy was actually bogged down with high inflation. Would you have bet against Japan back then? Probably not. Yet America bounced back massively to claim the dominance we see today. The core lesson here? Economic leadership always shifts. No single country stays on top forever.
So when we only invest in an American index, we are completely blinding ourselves to some massive, highly profitable global innovators. We're talking absolute heavyweights: TSMC, Samsung, Toyota, Tencent, AstraZeneca, HSBC. These are gigantic businesses operating at a global scale, driving real, tangible growth. But they get excluded from your passive US portfolio just because of where their headquarters happen to be located. It doesn't make a lot of sense. That's why smart money is preparing for the next big historical shift by pivoting into broad, low-fee global funds. Things like VWRP or Fidelity's international funds that hold thousands of companies all over the world.
If America ever stumbles, a true global fund automatically rebalances to capture the growth of whichever economy rises up to take its place.
Okay, let's keep it moving to part 3, the 4 zones of AI, and exactly how we can find real value without getting sucked into that crowded bubble.
If you look at the modern stock market right now, it's essentially split into 4 distinct zones. First up, you've got the crowded zone. These are your high market caps, incredibly expensive valuations. Your Nvidias, your Teslas, everyone, including all those passive index funds, is already crammed in here. Then you have the defensive zone. These are the boring but beautiful, stable cash generators. McDonald's, Walmart. They're great for long-term value, but you're definitely not getting explosive tech growth there. On the total opposite end of the spectrum is the speculative zone. This is filled with highly hyped, momentum-driven stocks with valuations completely divorced from reality. Think of the old hype cycles for things like Beyond Meat or Peloton. Honestly, playing in this zone is practically just gambling. But here is the secret. The real, uncrowded AI opportunity actually lives in the overlooked zone, the small and mid-cap companies.
Now, why are these smaller companies the actual hidden gems? Well, it's because artificial intelligence is rapidly becoming a lot like a petrol station or a gas station, depending on where you live. Right now, the massive tech giants are burning billions to build the absolute smartest foundational AI models. But smaller software startups and agile mid-cap businesses, they're starting to let their users simply pick between models like Claude, ChatGPT, or Gemini right inside their own apps. And because all these top-tier models are getting so similar in their capabilities, they're becoming completely interchangeable. Think about it. If one gas station sells fuel for $1.50 and the one across the street sells slightly better premium fuel for $3, almost everyone is just going to buy the cheaper fuel because it does the exact same job. When a new technology becomes good enough and interchangeable, the real financial value doesn't actually stay with the giant companies that sank billions into building it. That profit flows downstream to the agile, overlooked small and mid-cap underdogs who are smartly applying that AI to solve real-world problems at a fraction of the cost.
But listen, this technological leap isn't just shaking up the software industry. It is creating massive ripples in global power, currencies, and systemic trust. So let's jump into part 4, the new gold rush. Behind the scenes, the world's major geopolitical players are making some sweeping defensive moves right now. For years, China was quietly, steadily buying up gold. But recently, their purchasing has just absolutely exploded. And they aren't just locking it away in a dark vault somewhere. They are actively building what's known as a gold corridor. This is physical infrastructure that allows gold to be stored across different global locations and used as a tangible, hard form of trust in international trade. And this is specifically focused on the BRICS nations: Brazil, Russia, India, China, and South Africa. A lot of analysts look at this and see a highly calculated, aggressive move to build a whole new international trade system that completely bypasses the US dollar. But here's the thing, it is far from just China doing this. Central banks all over the planet are hoarding gold so fast that it actually just overtook US treasuries as the world's largest foreign reserve asset for the first time since 1996. So what's sparking this sudden, desperate rush for gold? Well, it essentially boils down to a massive financial reclassification, the Basel III Tier 1 asset. I know, that sounds like horribly dry financial jargon, but the crucial point is this. It means global banks are now legally permitted to treat physical gold exactly the same as cold, hard cash or US treasuries on their balance sheets. Before this rule change, banks literally weren't allowed to count gold's full value. But now, physical gold is quite literally as good as cash in the foundational banking system.
And because of that massive regulatory shift in the background, look at what is happening to the banking guidelines. Historically, major financial institutions kept about 20% of their reserves in gold and similar hard assets. But the new guidelines, like the ones recently published by Bank of America, are pushing that recommendation sharply up to 30%. That 10% jump? That represents an absolutely massive surge in global demand. And since you can't just digitally print more physical gold, that deep structural demand is incredibly likely to keep driving prices upward, which is exactly why holding a strategic, defensive portion of physical gold, or even just dollar-cost averaging into physical gold ETFs, is fast becoming a totally necessary play to protect against this shifting financial system.
Which leads us to our 5th and final section, why cash is king. Because honestly, amidst all this wild AI hype, shifting geopolitics, and complex market weightings, the single most powerful buffer you can possibly have is also the simplest.
$347.7 billion. Just let that absurdly massive number sit with you for a second. As of the first quarter of 2025, that is the exact amount of cash and cash equivalents being held by Warren Buffett, who is arguably the greatest investor in modern history. He has been aggressively growing this unbelievable mountain of cash over the last couple of years.
Why? Because Buffett is the ultimate value investor. He only buys when the price actually makes logical sense. And right now, looking at these debt-fueled AI valuations at the very top of the market, the smart money simply doesn't see opportunities that justify deploying that kind of capital. They are intentionally, patiently waiting on the sidelines for valuations to crash back down to reality.
So how do everyday investors like us actually mirror that billionaire strategy? Well, here are 3 actionable steps for managing your cash right now. Step 1, build a solid reserve. The single biggest mistake everyday investors make is not having cash when real life hits, which forces them to sell their stocks at the absolute worst possible time, just to cover an emergency. Step 2, patiently hold that cash while the broader market valuations are highly inflated by this AI bubble. And step 3, be ready to deploy it rapidly. Market crashes are a when, not an if. They always happen eventually. Having cash on hand is what gives you the ultimate superpower to buy the dip and scoop up incredible investments while the rest of the market is in total panic mode. Cash isn't just a safety net, it's dry powder for future opportunity.
So here's the big provocative question I want to leave you with today. Are you purposefully positioned for this AI revolution, or are you just blindly following the passive crowd straight into a highly concentrated bubble? As we've seen, relying entirely on just the top 10 tech giants of the S&P 500 carries massive hidden risks. But by diversifying globally, seeking out those overlooked small and mid-cap AI users, adding strategic buffers like gold, and keeping your cash powder dry for the inevitable market shifts, you can completely protect yourself and even thrive. So take a hard look at your own portfolio today. Based on everything we've unpacked, what moves are you going to make?